Eric here with an unscripted, authentic explanation on why people are terrible investors. So, just a word of warning, these videos are completely unscripted and are just my thoughts on various investing topics. Okay, so why do I believe that most investors are terrible investors? And by the way, that also includes most professional investors. It's not from a lack of trying, that's for sure. I can think of three reasons why it's really difficult for most people to beat the market and to be consistently good at investing. The three reasons are: number one, they don't have a system. That's probably not the case of a lot of professional investors, but for non-professionals, I think that's probably the number one reason. Number two, they focus on short-term results. And number three, they're overly emotional. And I think actually reasons number two and three are shared by both professional and non-professional investors. So let me talk about each of these in order, and I'll share some ideas on how you might be able to overcome some of these handicaps. Number one, not having a system. Well, the problem in the internet age is that there is a lot of information out there. It's too much information. And the other problem is that people tend to do what they want to do rather than doing something that works. And it's kind of like exercise. You know that if you eat good food, if you cut down on sweets and bad, and junk food, and you exercise, you will develop cardiovascular fitness. But that's, even though you know what to do, it's hard to do it. There are lots of different ways to make money in the stock market, and I don't have time to go through all the different ways. The way that I'm familiar with is the way that Warren Buffett does it, Peter Lynch, Charlie Munger, Howard Marks, the big hedge funds. A lot of them practice what is known as value investing, and that's an excellent system. In another video, I'll give you some tips on how to do value investing, or at least how I do it. But I'd highly recommend a book that greatly influenced me. It's a book that was written in the 80s, so it might be a little bit out of date just in terms of the writing style, but that system still works today. And the book that I'd recommend to you is One Up on Wall Street by Peter Lynch. He was the fund manager for the Fidelity Magellan Fund, and to this day is considered the best mutual fund manager of all time. So we recommend you read that book, develop a system, and whatever system you come up with, you have to stick with it. Number two, the focus on short-term results. Now, this one's a really tough one. There are deeply psychological reasons why people are short-term thinking. Don't have time to go into that, but I would just point out one thing that most people would agree with, and that is that if you thought about your personal goals, most of those financial goals are pretty long-term. So maybe you're saving for retirement. Maybe you're saving for your son or daughter's university tuition. The point being that your financial goal is usually on the order of decades. But for whatever reason, our focus and our orientation is usually much shorter. Some examples of this are people watching, the news constantly, financial news, looking at their statements or the prices of their stocks every day or every week, trading in and out, participating in the latest fads. So right now, and I'm not sure it's a fad, but I will just say that there's a lot of interest in cryptocurrencies right now. On the flip side, there's a mass panic during crashes. So whenever there's some bad news, and there hasn't been bad news in a long time, but in 2008, people literally just got out of the stock market. Obviously, they were doing it for emotional reasons, and most people got out probably at the very bottom. And this is a form of myopia. And it's sort of like if you ride a bicycle or drive a car or ride a motorcycle, looking at the very front of the wheel, right in front of your vehicle, and looking at the pavement. It looks like things are happening really fast. But the trick when you're driving or riding a motorcycle or a bicycle is to look out into the distance. And investing is analogous. If you're just checking everything and thinking short term, you're basically looking right in front of your vehicle, and everything seems to be happening really quickly. If you look out in the distance, you'll get more context and you'll make better decisions. Thirdly, emotions. Stock markets, well, all markets, frankly, consist of people, and it's no secret that the way that you make money in the stock market, rather, is you buy low and you sell high. And that means that because it's a market, you're going to need to be able to do things that are counter to what other people are doing, because it's supply and demand. If people are really, really interested in buying a house, guess what? The price of that house is going to be really high. If you want to buy that house when it's cheap, you're going to have to buy it when other people either are not interested in buying it or they can't afford to buy it and the demand is low. The problem is that we're pack animals, that just over millennia of evolution, for whatever reason, we take comfort in numbers and other people agreeing with what we're doing things together with others, and this creates a real problem in investing. I want to highlight two particular emotions that are very, very detrimental to investing. The first is fear. So this could be fear of a mispricing, fear of loss, fear of missing out, fear that whatever gains you've made will dissipate. The other emotion I want to highlight is greed. Wanting to jump on the train, wanting to make a lot of money, feelings that may override any caution. So again, this is very commonly talked about, fear and greed, but the solutions to these are not easy. So I just want to be totally upfront. There's a whole field of behavioral economics that talks about and analyzes why our emotions get the better of us, why we make irrational decisions. So this is a vast oversimplification, but I would point out three things that have helped me. The first is to, number one, develop an awareness of fear and greed and emotions while you're making decisions. Secondly, to make decisions with some distance. If you don't have to make the decision right now, my recommendation would be you write down what you want to do, sleep on it, or wait 1 or 2 days, and then come back to it and think about it when the emotions have died down. Thirdly, a trick that I've used is to ask yourself what a perfectly rational person would do if posed with this very same decision. And when I was growing up, I really liked watching the show Star Trek, and there was a character in Star Trek, Mr. Spock, who was very, very logical and tried very hard to not be emotional. And if you think about Spock, or if you want to think about a computer, somebody or something that is not as emotional, and you ask yourself, what would they do in this situation? That might provide some context into, or some suggestions in what you should be doing. So I hope this helps. If it has helped you, continue to watch the videos. I'll be posting a lot more. Again, they're unscripted, so forgive the ums and ahs. These are just quick and dirty videos to hopefully help you and to share my thoughts. Until next time, take care, and I'll talk to you soon.